You're watching the Daily Market Comment by Mario Sajikiriakos. I'm Cristina Marujos. Thank you for joining us at xm.com. Investors are having second thoughts about the structure of the Fed's rate hike cycle. The latest moves in the bond market suggest the FOMC will pull the hike trigger early to tame inflation, but the final destination in rates won't be very high, an earlier but shallower rate path. This is evident by the yield curve flattening, with short-term Treasury yields rising yesterday, while longer-term yields fell after the release of U.S. inflation data and the minutes of the latest Fed meeting. Inflation remained hot, with consumer prices rising 5.4% in yearly terms. Meanwhile, the minutes revealed that the Fed is planning to reduce its asset purchases by $15 billion per month starting in mid-November or mid-December. Inflation expectations have moved higher since this meeting thanks to the meteoric rise in energy prices, so markets concluded the Fed may be forced to tighten earlier to break the spiral, although its early actions imply rates won't need to rise too high overall. In the markets, the drop in longer-dated yields overshadowed everything else, breathing life back into equities and gold prices. Yield-sensitive tech and growth stocks benefited the most. The optimism has carried over into today's session, with Wall Street futures pointing to another positive open. That said, the technical structure still argues for caution, with the S&P 500 and the Nasdaq unable to record a higher high yet, even if stagflation worries have taken a back seat. Gold capitalized on the drop in longer-dated yields and the pullback in the dollar, shooting higher to meet resistance near its 200-day moving average. If yields continue to ease as traders bet that the terminal Fed rate will be lower, that would be fertile ground for bullion to extend its latest gains. However, any such gains should be viewed as a rebound within a broader downtrend, not a trend reversal. In a sense, gold is at the mercy of the bond market, which in turn remains at the mercy of the volatile energy market for now. In the FX spectrum, the dollar suffered some minor injuries from the latest gyrations in yields, although the yen has been much weaker this week. The main beneficiaries have been the commodity-linked currencies, and especially the Canadian dollar, that is riding the rally in oil prices. Finally, China's factory prices accelerated further according to the latest data, feeding concerns that the nation will begin exporting even more inflation abroad. This was the Daily Market Comment. Thank you for watching at xm.com.